Today is the 7th of February 2022. My name is David Hickson, and in today's market update I'm going to be taking a look at Bitcoin and also a quick update on the S&P 500 to update ourselves in terms of what has happened over the past week. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's change things about a little bit this week. We're going to take a look at Bitcoin first. This is the analysis that we were looking at in the previous update about Bitcoin, in which I discussed the possibility that we had witnessed a 54-month cycle peak. And that occurred, as you can see from this bar count over here, 89 days ago. And so I discussed in the previous market update the fact that the analysis seemed to have shifted from being a very reliable trough analysis. And a quick reminder, we are looking at two separate analyses on this chart. At the foot of the chart is the trough-based analysis, in other words, assuming that the cycles are synchronized at their troughs. And at the top of the chart is the results of an analysis assuming that cycles are synchronized at their peaks. And of course, we don't know when it comes to Bitcoin relative to the United States dollar, which is what this is a chart of. We don't know whether the cycles are synchronized at their troughs or at their peaks. Hurst did his initial research on stocks in the US stock market, and there is very clear evidence that those cycles are synchronized at their troughs. There is also fairly good evidence that the price of gold, for instance, is in fact influenced by cycles synchronized at their peaks. When it comes to Bitcoin, we don't really know. And as mentioned in previous market updates about the price of Bitcoin, I've discussed the fact that a trough-based analysis was working very well up until really just a couple of months ago. And so the trough analysis is not as good as it was a few months ago. And as discussed in the previous market update, the peak analysis seems to be a lot more reliable. If you haven't seen that market update, I would encourage you to go back and take a look at it, because I'm not going to be repeating all of that information here. The interesting thing to observe about this analysis, starting with the consideration of the troughs, is that the 20-week cycle trough, which I was considering placing at this position over here at the end of November, or in fact I think that was the beginning of December, the 20-week cycle trough now seems to have found its position over here. That results in a fairly long 20-week cycle. As you can see, if we measure the number of bars, there were 188 bars or days that elapsed in that 20-week cycle. That's fairly long for a 20-week cycle. The average length of a 20-week cycle is 136 days. If you don't understand why the average length of a 20-week cycle is 136 days, I would encourage you to download the 10 core concepts of Hurst cycles document that I will provide a link to beneath this video. So that is a fairly long 20-week cycle, but not impossibly long. It is just possible. And of course, what is to some extent more important than the actual length of the cycle is the way in which the analysis breaks down. And so you can see, if we just very roughly draw some of the shapes that we're seeing here, we get a fairly typical sort of an M shape the cycles tend to form that has elapsed over that 189 days. We get a bit of a skew 80-day cycle trough over here, but it is by no means an impossible analysis, and so it is certainly very viable. But as I observed in the previous market update about Bitcoin, the emphasis, or sometimes I refer to it as the dominance in terms of these analysis, seems to have transferred over to the peaks. And so, in my opinion, the peak analysis has become the more important one. I don't know why that is. Why is it that all of a sudden the cycles seem to be influenced more in terms of their synchronized peaks than synchronizing at their troughs? I don't know the reason why, but certainly the evidence displayed on this chart seems to provide us with an argument that is fairly strong that the peaks have been fairly dominant recently. So what is happening in terms of this analysis? Well, as I mentioned in the previous market update, we of course have experienced a bit of a trough over here, possibly a 20-week cycle trough. There is an alternate possibility, which is that the 20-week cycle trough formed over there and that this is a smaller magnitude trough, but I tend to favor the fact that a 20-week cycle trough has formed over there. What is more important, however, is what is happening in terms of the peaks. And so this was clearly a fairly big magnitude peak. As mentioned and as shown on this chart, it is phased in this analysis as a 54-month cycle peak. I tend to not take that too seriously. In my opinion, it was a peak of at least 18 months. It might have been a 54-month cycle peak. But let's discuss what has been happening since then and what we expect to happen as a result of that. Let me zoom in a little bit over here and let's focus on the peak analysis. In fact, I will even hide the trough analysis so that we are not distracted by it. And so here is our peak analysis. Now, following a peak of high magnitude of at least 18 months in this case, the first thing that would happen is that price will of course move strongly down, and when it comes to interactions with the FLD, which is again something I speak about in all of these market update videos, and I will place a link below this video that discusses the FLD trading strategy, but it is a process whereby we track the interactions between price and the FLD. So where would we expect the first 80-day cycle peak to occur? Of course, we would expect it to occur at the level of the 80-day cycle FLD. So let's display the FLD for the 80-day cycle. There is the FLD for the 80-day cycle. You might notice that it is a dashed line, whereas most of the FLDs I display are solid lines. The reason for that is because this is an FLD based upon the peak analysis. Of course, we are considering the peak analysis and we're looking at interactions between price and the FLD based upon the peak analysis. And so the first thing that we would expect to happen in terms of the 80-day cycle FLD is that price will cross down below the FLD. That's an A category interaction, and it would reach down and achieve its target, which it pretty much did over here. And then at about the time of the 80-day cycle peak, we would expect the 80-day cycle FLD to provide resistance, which is pretty much what it did over here, as you can see. You will notice that I've pinned that 80-day cycle peak in that position. That's because I've influenced this analysis. If we take a look, and we'll just quickly pop over to the other chart and do that, what would happen if I had not pinned the analysis in this way? Here is an example of an analysis that I have not pinned. I have not influenced it in any way. There is still, of course, a 54-month cycle peak over here. You will notice the circle of the 80-day cycle peak telling us that this was, in fact, the exact time that the peak was expected. The whiskers, which are the lines to each side of that circle, represent the range of time in which we could reasonably expect that peak to have occurred. Now, this sometimes happens in an analysis where you will see a fairly clear peak or trough form, and in this case it has been phased as the 40-day cycle peak over there. However, you have a floating circle and whisker almost directly above or below it, and in my opinion it is often the case that the 80-day cycle peak has in fact formed at that position over there. The reason why the software has not yet positioned the 80-day cycle peak there is because it is not impossible that the 80-day cycle peak is still going to form. Remember, I pointed out that there have been 89 days that have elapsed since the peak in November. 89 days is not an impossibly long length for an 80-day cycle, and so it is possible that this was only the 40-day cycle peak that formed over here, and that we are going to soon see an 80-day cycle peak. But we are going to put that consideration aside for a moment and come back to this other chart where I have influenced the analysis and positioned the 80-day cycle peak over there. And one of the reasons why I believe that is probably the correct position for the 80-day cycle is because of the fact the price pretty much found resistance at the level of the 80-day cycle FLD. So what is going to happen now in terms of the peak analysis? Well, I started labeling the sequence of interactions, so let me quickly resume that. That was an A category interaction. It's a very poorly written A. That's an A category interaction that achieved its target. The point at which price came up and found resistance was a B category interaction. The C category interaction, and nowadays I tend to describe these interactions as a BC category interaction because the two of them basically occur as a coupled pair. And so the C category interaction is where price moves back down away from the FLD. Remember, we are considering a peak analysis, and so everything is very simply inverted. You are used to me discussing the sequence of interactions on a trough-based analysis, but when we're looking at a peak-based analysis, we simply invert everything. So the next interaction between price and the 80-day FLD is happening right now, which is why I thought this would be an interesting thing to look at today, and that is expected to be a D category interaction. What do we expect from a D category interaction based upon a peak analysis? We would expect price to cross above the 80-day FLD and achieve its target to the upside. We will calculate the target on the basis of where the price manages to cross the FLD, and we will extend an equal distance to the upside, generating a target somewhere over here. So it would be about 50,000, 52,000 maybe as a target for that move, depending on where price actually manages to cross above the FLD. We have to wait until that cross before we can calculate the target. But now, the D category interaction would then take us up to the 20-week cycle peak. There is the nest of highs for the 20-week cycle peak. So you can see that around about the end of February, perhaps early March, we are expecting a 20-week cycle peak. Now let's extend this logic just a little further. What is expected to happen between price and the 20-week cycle FLD at the time that the first 20-week cycle peak forms following a major peak such as we witnessed in November of last year? I hope that you have already worked out the answer to that. We would expect price to find resistance at the level of the 20-week cycle FLD at the time that the 20-week cycle forms its first peak following a major cycle peak such as we saw in November. Therefore, this 20-week cycle FLD provides us with another suitable area for a potential target for price to reach as the 20-week cycle peak is formed. I hope that makes sense to you. Let me zoom in a little bit and let's consider in a little more detail exactly what I have just explained. We are expecting price to cross above the 80-day cycle FLD and generate a target to the upside, which will be equal to the distance from the FLD, equal to the distance that it traveled from this trough, this low point on the 24th of January, up to the level of the FLD extended upwards. That is where the target would be. We might expect to find it somewhere around about over here. This is the time at which the 20-week cycle peak is expected. It's that inverted triangle, and so it is expected roughly in the last week of February. That's an approximation, of course, but another good place at which we could expect price to meet resistance or achieve its target would be the level of the 20-week FLD. And so we have an interesting situation developing. We are expecting Bitcoin to get across the 80-day FLD, work its way up to a 20-week cycle peak and find resistance at about the level of the 20-week cycle FLD. And so that's what we're expecting in Bitcoin. Let's quickly update what is happening in the S&P 500. In last week's market update, I discussed the situation in the S&P 500. I presented two possibilities. One possibility was that the 20-week cycle trough might have formed on the 24th of January. The other possibility was that that might indeed be an 18-month cycle trough, which is quite an interesting idea. So nothing has actually changed. The only reason I thought I would take a quick look is because we received many emails, and I think there were some comments on YouTube and Twitters or tweets, tweets, asking whether the FLD had been crossed. And of course, the 20-day cycle FLD was crossed last week. In fact, it was crossed pretty much as I was recording the video. But of course, we are looking at median price. You must remember, we base the FLD upon median price. So we need to look at a line on median chart. And you can see that the actual price crossed, the level at which the median price crossed the FLD was over there, that lower mark. And so, yes, indeed, price did cross above the FLD. What that actually tells us is when price crosses above a 20-day FLD, it confirms that the magnitude of the trough that has formed in the market is of at least 20-day magnitude. That's actually all that price crossing the FLD tells us, that the trough that has formed in the market is of at least 20-day magnitude. It does not confirm the fact that a 20-week cycle trough has formed. However, because of the way in which we track the sequence of interactions between price and the FLD, as discussed in previous market update videos, and I went through the entire sequence of interactions, the fact that price crossed up above the FLD at this time gives us reason to believe that the 20-week cycle trough, or indeed 18-month cycle trough, might have occurred early. Again, here is the whisker for the 20-week cycle, and of course the circle for the 20-week cycle. This is our nest of lows. The 24th of January was just within the reasonable range of time in which the 20-week cycle trough could have formed. An interesting situation has developed in terms of the analysis, and that is that Sentient Trader has positioned only a 20-day cycle trough over there and not this big magnitude trough. Why is that? Because one of the most dangerous things that you can do as an analyst is jump to the conclusion that a trough has formed. And so Sentient Trader is a little reluctant to jump to that conclusion. We need to use our slightly more advanced human brains to interpret the situation. It seems very likely that a 20-week cycle trough has formed, and we need to make our trading decisions on the basis of that. It is not impossible that price could come down lower and form a 20-week cycle trough at a lower point before actually turning upwards. How early is this 20-week cycle trough? It is in fact only about 15% early. If you count the number of bars that led up to the trough on the 24th of January from the 18-month cycle trough, according to this analysis at the beginning of October, you will find that that is only about 15% short. It indicates only a 15% variation, which is not really a very big variation. In terms of the 80-day cycle, which probably formed a cycle trough here at the beginning of December, that represents a slightly greater variation of 21%. That's a greater variation, but it's by no means impossible. What is the maximum variation that you can encounter? Hurst actually never defined a maximum variation. All that he stated was that we should expect variation in wavelength and amplitude, and also in various other things, which we don't have time to discuss now. So it was certainly an early trough if it did form there, but it is not impossible that price will come down and form a lower trough. So what should we be doing? Well, I can tell you what I'm doing. As mentioned in last week's market update, I often miss the A category opportunity. I often miss getting into a long trade at the A category position, particularly when we have a situation with an early cycle trough forming. And the reason for that is because you're not sure whether the FLD is going to provide resistance, and this is going to turn into a G category interaction and price is going to move down into the trough a little later, or whether in fact it is the beginning of a long move. This looks as if though the trough has formed. So what should happen next? Well, of course, this would be an A category interaction if that trough has formed, and now we would expect price to find support at the level of the FLD, and that should give us a good opportunity to get into the long trade. What I like to do is watch and see how price reacts to the FLD as it comes down here. If it plunges downwards, then of course it might be on its way down to another trough. But if it looks as if though it is finding support, that would give us an excellent opportunity to get into a long trade at that time. Let's take a look at the other possibility, which is that an 18-month cycle trough might have formed on the 24th of January. And here is that analysis, and I find it really interesting that Sentient Trader has in fact positioned the 18-month cycle trough over here. The reason for that is because the 18-month cycle trough, according to this analysis, which I showed you in the previous market update, was really overdue. There were over 600 days had elapsed if the 18-month cycle trough was to have formed here. So when a cycle trough is really overdue, then we are not jumping to premature decisions in terms of placing that cycle trough there. And so Sentient Trader is more willing to position the cycle trough over there. And so you can see it is certainly possible that the 18-month cycle trough has formed here. The FLD is in a slightly different position in this analysis, as you can see. The reason for that is because the 20-day cycle has a different wavelength according to this analysis. And so price has only just recently crossed up above the FLD, but it has nevertheless crossed above that FLD. So again, things are looking good for that trough to have formed in this position on the 24th of January. Let's just zoom back and take a look at that full 18-month cycle. Here is that analysis again with the 54-month or possibly even a 9-year cycle trough over here in March of 2020. This analysis positions the 40-week cycle over here in March in a fairly questionable position, but then it is very difficult to decide what magnitude each one of these troughs was because of the fact that the market was moving upwards so relentlessly at this time. And so here is the 18-month cycle trough according to this analysis. And as I mentioned a moment ago, there were 672 days that elapsed. Many Hurst cycles analysts would consider that an impossibly long length for an 18-month cycle. However, as I pointed out in last week's market update, it was the possibility was brought up by a member of our community who suggested that we measure the distance from the December 2018 18-month cycle trough up until the trough at the end of January. And in fact, that works out very interestingly at 37.5 months, I think it was. I'd presented this in our previous market update video. I'm not going to repeat it here, but it is just possible that because of what might be described as fundamental interactions surrounding the outbreak of the pandemic, that we experienced this trough in March of 2020 earlier than it would have been expected to have been experienced strictly because of the cycles. And so it is a very interesting possibility that we have witnessed an 18-month cycle trough that has formed over here on the 24th of January. I am going to be watching very carefully as price comes down towards the 20-day cycle FLD to see how price reacts. If it shows evidence of finding support, then in my opinion that would provide a good opportunity for us to enter into a long trade to benefit from the bounce out of either the 20-week cycle trough or possibly the 18-month cycle trough. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below this video. I look forward to hearing from you.